Okay, good afternoon, good morning, depending on where you are. Looks like we've got some more people that are joining now, but we'll go ahead and get started on time here for everyone. Thanks for taking some time out of your day. The topic of today's discussion is, am I making the right moves in my 401k? And so we just want to be brief and cover two really main points that we see with issues that happen within 401k contributions and the like. And as you get closer to retirement, some things you need to consider, especially in this market environment. So with us today, it's myself, Chad Seegers, a managing partner with Insight in Houston, and one of our senior lead advisors, Tim Raftis, who's in our San Ramon office. The key points we want to talk about: watch out with your max contribution timing. You could be leaving some money on the table, as we'll look at in a minute. And then growing popularity is after-tax contributions with 401k plans, and moving those over to Roth IRAs. It's kind of a big mistake that we see with money being left on the table. And we want to take a look at what's called a glide path as you get closer to retirement. And the reason why that's important due to sequence of return risk near and after retirement. So let's look at high-level strategies while we're employed and look at a few key numbers most people are aware of, but we want to review and make sure that we're talking about basic contribution numbers.
Thanks, Chad. Good morning, everyone. So 401k is a really powerful retirement tool that allows you to save and invest for your own retirement on a tax-deferred basis. Contributing pre-tax dollars via your paycheck to a 401k reduces your taxable income, and the earnings and appreciation on those contributions are not taxed until you start withdrawing money. Now, your employer may also offer a Roth 401k. With a Roth 401k, you pay taxes on contributions before they are deposited to your account, but will not be taxed when you start withdrawing money. So let's take a look at a few of the key numbers. So in 2022, you're allowed to contribute up to $20,500 to your 401k as an employee. Now, if you're 50 years of age or older, you can contribute an additional $6,500 as a catch-up contribution. Now, your employer may also offer to match a certain percentage of your contributions. Now, this is free tax-deferred money from your employer, so it's important that you contribute at least enough to receive the employer match if there is one. In addition to the employer match, your employer may allow you to make after-tax contributions up to $40,500, including any employer match or profit sharing. So all in, you may be able to contribute a total of $67,500 in 2022. So let's take a look at an example. Joe's 53 years old. He receives an annual salary of $230,000 plus a 30% bonus of $69,000 for total earnings of $299,000. So he can contribute $20,500 in 2022 to a pre-tax or Roth 401k. He can contribute $6,500 as a catch-up contribution since he's 50 years of age or older. And then Joe's company offers an employer match on contributions up to 8% of total earnings, or $23,920. Joe's company also allows after-tax contributions. So Joe can contribute an additional $16,580 to reach that maximum contribution limit of $67,500.
Thanks, Tim. So, running through that, these are IRS limitations that are put out there that we all have to abide by, and based on where you are income level wise and where your company may be from a bonus standpoint, and when that hits throughout the year, that could stop you out of realizing some of these dollar amounts. And so the pre-tax amount, $20,500, you then have that over age 50 catch up. So you got up to $27,000 of your total dollars that you could put into the plan. And then your employer match, which gets you to total contributions between yourself and employer. And then you have that after tax that's very popular in a lot of plans now. And what we see is those after tax dollars are not being moved over into Roth IRA via transfer, which we'll go into detail as to why that's important in a moment. But this is how you get to the IRS max of $67,500 that can actually be put away into a 401k plan. That's all well and good. Now, let's look at an issue with this. This is something very common we see, feedback we get when we're reviewing with clients throughout the year, early on especially, as well. I'm maxing out my 401k, but I'm not contributing anything after May, or I'm not contributing anything after September. And that's where we see some issue, and there's some money left on the table. So let's look at this scenario. Individual makes $230,000, 30% bonus or SIP if you're at Chevron. So you're maxing out your 401k with a 12% contribution. You're a great saver. Most people put their contribution percentage in place several years ago. Their income has gone up over the years. Bonuses fluctuate over the years, and they haven't really adjusted it. And so now in this scenario, this individual that's doing a great job saving and actually maxing out their individual IRS contribution level, $27,000, they're having to stop their contributions in September because IRS rule says you cannot put any more dollars into the plan yourself, Roth or pre-tax 401k, after you meet that max 27,000. However, in this scenario, if you run how the employer match works, that employer match stops also in September because no more contributions are being made. And the employer only put in $18,107. Well, based on IRS rules, the employer could have and should have, in this case, put up to $23,920 into the 401k plan. And so that's missed opportunity, around $5,800 a year that's being left on the table of what your employer would match and put into the plan. A way to fix this for most people are these after-tax contributions at the last column. That would have been an additional $16,580 that you could put into the 401k plan that would allow you to receive that additional $5,800 at company match, that free money there. And then also max out what you can put into the plan in your highest earning years typically. So you're looking at a situation where you have missed opportunity of around $22,000. How do you fix it? The obvious one is you lower your contribution percentage and you spread it out over the year. Income's gone up, maybe bonuses are higher than they used to be. You can simply lower it from 12 to 10, simple example. Or you can switch to after-tax contributions, and then you get to take advantage of another unique strategy we'll look at. There's pretty interesting tools out there. Fidelity is one of the largest providers of 401k plans. They have a tool that is actually free for everyone to use. It's called Chevron Deferral Tool. With your own company 401k, they may have a deferral tool as well. We walk clients through this, and this is part of the work that we do when we're handling our reviews. You put in your basic information, your date of hire, how often are you paid, what amounts have you put into the various buckets already this year, and it will tell you results to where you can see here the middle column of what's recommended to do inside your 401k contributions and what you're currently doing. And so as you see, you're leaving some opportunity on the table. And the great thing about this is it spits out in the bottom left exactly where you need to send those source contributions. 2% into before tax or Roth, 6% into before tax or Roth supplemental, after tax basic, and then after tax supplemental. So this is a pretty interesting tool that gets into the detail. It's a very common question we get: where should I be putting my contributions throughout the year to max things out? And so let's talk about this after-tax contribution piece. I'd say this is the number 2 thing we see. Individuals do a great job of saving. They're putting money into the after-tax portion of their 401k for years. And maybe they have, in this case, $356,000 and that after-tax balance on the statement when they get ready to retire. And in your mind, you rightfully think, well, I've paid taxes on these dollars already. Why should I have to pay taxes on that again? Well, if you put in $17,000 a year over 10 years, you contribute $170. You end up with a balance of $356 just in total market gains. So that's pretty significant, $186,000 in gains. However, the rule says you have to pay taxes on the gains of after tax if they're left inside the 401k plan. And so in this scenario, you end up paying about $72,000 of unnecessary taxes after you finally retire and remove this bucket of money. You actually have the ability in most 401k plans throughout the year to remove those after-tax contributions and send them to a Roth IRA via transfer. And so Let's separate the two. These are not Roth IRA contributions, as there are income limitations to that. If you make too much money, you can't contribute to a Roth IRA. This is a rule that is still available to people. You can remove your after-tax contributions, transfer them to a Roth IRA, and then the growth, that $186,000 in this case, would be in a tax-free forever bucket inside a Roth IRA. You're creating some asset location strategy. You're creating a situation where you're not exposing this part of the 401k to the future required minimum distributions after you're age 72, which that's going to get pushed to 75 later. There's all sorts of unique benefits, but the biggest takeaway is you're not going to be paying ordinary income tax on that. So what do we mean? Most people know you put money into a 401k, grows tax-free because it's pre-tax dollars for the most part. When you take it out, it's taxed as ordinary income tax, just like your paycheck. Those after-tax contributions, put the money away, those contributions can be taken out, return of principal, no taxes are paid on it. However, the earnings, again, those get taxed as ordinary income. And so unique strategy, I would say, to implement is systematically transfer these after-tax contributions throughout the year to a Roth IRA that you have set up. And that gets that growth, that future growth in tax-free land, instead of paying taxes on these earnings again down the road like you would with the majority of 401ks. So now let's take a look at some strategies, high level, for separation and service and what you can actually do with the money via regulation.
Great, thanks, Chad. So what do you do with your 401k if you leave your employer or you retire? There are a number of options. First one being you can leave your 401k with your former employer. Potential downside to this is that you tend to forget about that 401k and lose track of it. And over time, the balances may move out of your target range if you don't rebalance them. Now, if you're separating from service going to a new employer, if the new employer allows it, you can move your former employer 401k into your new employer 401k. This eliminates the need to monitor multiple accounts and different investments between the two. The third option is rolling it over. You can do a direct rollover from your former 401k, employer 401k, into an IRA account. You'll have access to broader choice of investments and the opportunity to get investment guidance. Also, if you have company stock in your retirement plan, you may be able to take advantage of what we call net unrealized appreciation and pay tax at more favorable long-term capital gains tax rates. So essentially, you pay ordinary income tax on the purchase price of the shares, and you pay long-term capital gains taxes on the growth of those shares. There are certain requirements that need to be met, which is a separate topic for another time, but we wanted you to be aware of it. And then the last option is cashing out of your 401k. You can do this, but you'll pay income taxes on the entire distribution. And if you're under 59 and a half, you'll also be subject to an additional 10% penalty. You'll also give up the potential for future growth, which would have continued to grow tax deferred if you had kept it there until retirement. If you do cash out, you do have 60 days to deposit the entire amount into an IRA account to avoid those taxes and penalties.
Thanks, Tim. Well, one thing I might add, this mechanism, when there's money in motion, this is the part that we see a lot of times things handled incorrectly. A lot of times with those after-tax buckets, more and more providers are accounting for them correctly, and they're not just simply rolling money over into an IRA and commingling after-tax dollars with pre-tax dollars. And so those buckets should actually be broken out, and they should be specified where they're going to go. Pre-tax goes to an IRA, after-tax contributions go to a Roth IRA. This NUA thing here with company stock, that actually goes to a non-retirement account. And so there's some detailed analysis that needs to be done before this event is quote unquote triggered, just from a logistics point of view. And so let's look at some strategies for post-retirement. We could spend an hour or two talking about what's going on with the markets right now. It's pretty obvious that we're at peak earnings growth within the stock market. That doesn't mean we're not growing anymore. I think it's pretty obvious to most people that we're at peak economic growth at this stage in the cycle. It's debatable whether or not recession is coming or not. Regardless of where we are in the market cycle, I think some things to consider that a lot of people that are in accumulation mode may not be aware of is how drawdowns affect you early on. And so let's look at some scenarios. Left-hand side, we have an individual that's been saving and investing for a period of time, like most of us do when we're working for 35, 40 years. As you see here, you have a different sequence of returns. You end up with an average annual return of 6%, same starting value, same ending value, even though your return sequence was different. Now, what's unique about this, as you get into retirement and income generation mode, and even close to retirement, if you have that same return sequence and you're withdrawing money from a portfolio, you do put yourself in a position of sequence of return risk, which is something that we care a lot about in the financial planning world. And so the same scenario, you've got a 6% average annual return throughout this time series. In an up market, you're withdrawing money. You end up with more money than what you started with. That's all well and good. If you start out in a down market, something like tech bubble bursting, retire year 2000, you do have a probability of running out of money before you're ready to move on. And so sequence of return risk is a big issue because most people are saving and investing in a retirement plan in the stock market for the most part. We talk about bonds with a lot of people as they near retirement, and they common response is, well, I don't own any bonds. I really never have. I don't really get why they make sense. They pay me 3 or 4% interest. Well, taking a slightly more conservative approach during your distribution phase actually gives you a higher probability outcome. And so this is a 20-year data set, and we chose this data set because you went through some pretty bad periods. You went through the tech bubble, 2000 bursting, and then the financial crisis happening, large downturn in 2011 as well. And what you see here is interesting. You have what most people typically do is just invest in the market in blue, and you have a more conservative portfolio, just call it 60% equities and 40% bonds in orange. And this individual started out with $1 million, and they took money out this entire time. You go through tech bubble, you go through financial crisis, and now here we are. They have more money than what they started with. And cumulative distributions are now more than what they originally started with as well. And what you notice about this is what doesn't sort of jump off of the page from a numbers perspective is we saw people make behavioral errors when they were too aggressive as they were entering in retirement or in retirement. And they may cash out at the market, at the ultimate low and not get back in. Essentially, when this blue line is down around 400,000, 500,000 or so, that hurts. That hurts a lot. And it takes a long time to recover. Most individuals don't have the investment behavior to withstand it. Our view is you should take a little bit more conservative view the majority of the time as you get near retirement and actually in retirement because of this income generation mechanism. And so what can you do to combat that sequence of return risk? We believe in taking a bucket approach. Very simply, looking at cash flow analysis, we want to identify what are 12 months worth of expenses for you. What does it cost to be you? Cash. You can reduce this to 6 months of forward expenses after major projects are done. We actually see a lot of times this gets increased to 12, 18, 24 months because a lot of people move when they retire. There's some transition dollars that need to take place. And so you want to identify exactly what that balance should be. That next bucket is conservative bucket. This is forward looking, 3 years worth of expense needs. It's not in the stock market. This sort of targets a 6% standard deviation. So a bad year this year, for example, that money is down about 9%. It's second worst year since 1981. But you're going to have at least some part of that portfolio 1 year's worth of expenses within that's in a least volatile asset like short-term bonds that are down maybe 2% right now. And the remainder is going to be in a diversified basket of bonds, which are down year to date, but they're up 3 and 5 years pretty substantially. And so you want to identify what dollar amount that should be, and this is sort of a minimum threshold. Reason being, there's data behind what a recession drawdown looks like and what a recovery looks like. Call it 18 months from drawdown then to recovery of the stock market. And you want to put yourself in a position where you are flowing through market cycles throughout retirement, and you're not pulling from those assets that are down, actually. Then you have the long-term growth engines of your retirement life, and that's going to be your moderate bucket. This is dividend-paying companies. Even our most conservative investors are going to own some percentage in dividend-paying stocks. Those are companies that are not going to be sold long-term, minimum volatility style companies, core quality U.S. equities, and some global bonds occasionally when they make sense. And so you want to take a look at what dollar amount should be in this bucket as well. And then you've got your long-term growth engine. These are high growth asset classes, incredibly volatile asset classes, small, mid-sized U.S. companies, international investments, emerging markets, which are extremely volatile and infrequently have high returns. And so most people have no exposure to minimal exposure here, although they can give you some nice returns occasionally. And so when they do, they give you outsized returns. The mechanism is to actually rebalance and harvest gains in these volatile asset classes when they're above average performing. And then you take a look at in the moderate bucket and say, okay, do I need to buy any more dividend paying companies right now? Are they cheap or prices depressed? If not, do I need to fill up this conservative bucket? Is the bond market down? Do I have a wedding I need to pay for in a year or so? Do I need to help out kids with a down payment? Is there some type of project? Is there a vacation of a lifetime that we're going to be planning for? Example for this last year was large growth companies. Large growth companies did exceptionally well over the past 5 years. And so a lot of the gains harvesting was coming from that part of the portfolio. Lo and behold, you have a year like this year when those growth assets are down a lot. And so this is the architecture behind the scenes and the mechanism of dividends being paid out, and then the mechanism of gains harvesting and rebalancing to fill up those other buckets forward looking throughout retirement. And this puts you in a position where you're pretty high probability you're not going to be drawing from the stock market when it's down. You won't need to touch that stuff. So high level, this is just some of the work that we do in the retirement planning space, what we talked about today. That was a very brief high level annualized cash flow analysis and taking a look at the employer benefits maximization. Social Security analysis is a pretty popular thing that we start looking at near retirement. Some of the other areas we didn't talk about that are discussions in themselves. What do we need to do in the risk management piece? We need a lot of people that have too much life insurance, frankly, at this stage in their career. The estate planning piece, do you have documents in place? And then finally, with the wealth management piece, which is a long topic in itself with the investment management arena. And we talked very briefly about some tax reduction strategies with those after-tax contributions. If you leave and you remember one thing, it's remove those after-tax contributions, set up a Roth IRA somewhere, transfer those after-tax contributions to a Roth IRA. You're doing yourself a huge favor there. So we'll stop here and open it up for any questions that we may have. It looks like we have a few in the Q&A now. Question, speculating and preparing for a market crash. Yeah, high level, preparing for a market crash, you want to take down highest risk assets, essentially the stuff that's been doing very, very well in the past several years. Again, the market discussion is something in itself. It's more of a one-on-one thing, I would say, than purpose of the discussion today, but a lot of growth assets are still relatively expensive. You've got some cheaper portions of the U.S. market, but a lot of people, if you think about it, have now gone through 2 or 3 years where the stock market has done extremely well. And that's great, but they haven't harvested any of those gains at all. And we're now in a period where the bond market has done extremely poor because interest rates have now come up and they may be nearing sort of a cap. And so if you had to take a guess at what's going to happen in the future, there's probably a high probability that the bond market will do quite nice. Stock market will have continued volatility as there are some unanswered questions about inflation. There are unanswered questions about corporate earnings. Companies are still growing now. What's going to happen 9, 12 months from now, it's a different discussion. the line in the sand when you think about equity market drawdowns is when the market's down 22% or less, that tends to be about the stopping point for major market sell-offs, which we hit 20% and change a week or two ago. If you're down more than 22% from a stock market drawdown, a true bear market, that tends to be a little bit more severe drawdown within the market. I mean, some bad things are happening. So there's a lot of data points around sort of next steps within the market. I would say high level right now is to take a look at where you are from a risk perspective. And those assets that have been really good to you the past several years, don't fall too much in love with them. They will break your heart as things get repriced. Higher interest rates means that there's a revaluing right now the price you're paying for future earnings of businesses. There's a revalue right now of cost of capital for businesses. Interest rates are higher. That means lending rates are higher for you, for me, for all companies as well. Mortgage rates, auto loans. So a lot of things need to be reset. Many things have already been reset. It's not a foregone conclusion that recession is imminent tomorrow, but I think in this environment, you want to take down the highest risk assets you have simply by virtue of rebalancing and buying some of the boring stuff that no one has loved for several years.
I would just add, Chad, that going back to your slide on the various buckets, really important to have cash on hand so you're not having to tap your 401k plan or other retirement assets. So you kind of want to be able to ride out this market volatility, and having some cash on hand in other accounts, non-retirement accounts, allows you to not have to sell anything when it's down.
Question I have, does everyone qualify for a Roth IRA? I thought there was a max income threshold. That's a great question. So anyone can open up a Roth IRA. The key income threshold that most people are aware of is contributions to a Roth IRA, meaning take out your checkbook and you write a check and you contribute the $6,500, whatever it is for this year, as a contribution to that Roth IRA. What we were describing a little bit earlier, this actually is a transfer mechanism of after-tax contributions, right? So under 401k rules, you can make after-tax contributions. You're then transferring those assets to a Roth IRA. You're not contributing them to a Roth IRA. And so this is just a little wrinkle in the regs that say that you can actually do this regardless of income limitation. The frequency in which that you can remove this from your 401k plan, it's dependent by plan documents mostly. A lot of companies for several years said you could do it once a year. Some companies now say you could do it once a month if you want to. Some companies can have it set up automatically. This is typically done via phone call. A lot of times we get on the phone with clients and their 401k plan provider and help execute this thing and drive it. But that's a great question. To clarify, no income limitation when you're removing these after-tax contributions and opening up that Roth IRA, because it's not an actual contribution to the Roth IRA. That's where the income limit applies. But great question. Question here, can Insight help me while I'm employed if we're not the company's 401k plan? Yeah, that's pretty common. We work with a lot of folks that are 3 to 5 years out from retirement. That's pretty common. And so while we can't get into physically placed trades, a lot of stuff that we help with is where these contributions should be going, high level asset allocation within the plan as well.
Yeah, we also, we offer investment management for other accounts outside your 401k. So if you have taxable accounts or IRA accounts, we do offer investment advice there. And then just preparing for retirement, we offer comprehensive financial planning that sets you up to have confidence as you're heading into retirement, that you have a solid financial foundation so that your money doesn't outlive you don't outlive your assets.
Question here from Mark. Hello, Mark. What specific changes in investment directions do you recommend in the increasingly higher chance of a recession? So a little bit different question than we had earlier. There are market cycles that have existed throughout time, and there are different asset classes that do well depending on where you are in that market cycle. And I would say high level, as most people have seen with companies like Target selling off like crazy and Walmart selling off like crazy, and some other companies doing well, companies that are still reasonably priced. This is old school value style investing, but reasonably priced relative to the money that they're making, aren't being penalized as much at this stage in the cycle, and they should hold up fairly well. The companies that are being penalized the most and will continue to get penalized the most, frankly, is if you think about it, when growth ultimately does slow down, it's the consensus view. Now it's a lot of speculation that growth slowing down. That means that these companies that are deemed expensive by what you're paying for, common ratio is price to earnings ratio. What you're paying for the growth of that company's earnings is expensive right now. They're getting penalized a lot. You saw that with a lot of IPOs. You saw that with Zoom Video, which was briefly worth more money than ExxonMobil was. And it turns out Zoom, as much as we love the tool and everyone else has used Zoom throughout the pandemic, there's only so much money they can make with subscriptions to this digital service. And they haven't really shown they can make any more money than that. And the company is down 1 point at 80 or 90%. And so you're going to see that type of thing continue to happen with high growth companies that the growth simply didn't come to fruition. Therefore, investors start to question whether or not they need to pay a high premium for that growth, and those assets sell off. And so as you prepare for upcoming recession, you get back to boring quality businesses, frankly, that people are going to continue to use. Consumer staples, I would say, is a popular sector right now. I would say an asterisk and caveat being that consumer staples have been bid up and they're still somewhat expensive. And so you have to take a look at some other stuff. Healthcare is a sector that's interesting. Everyone is in energy right now. It's a debate whether or not it's cheap or expensive, but it's going to be dependent on the price of oil. Financials are relatively cheap right now. But to answer the question, you want to get back to sort of core, reasonably priced businesses. They tend to do well, early retirement phase. And then what tends to happen is once everyone realizes you're in a recession, markets tend to bottom halfway through a recession. And so it's not going to be on the news that they all clear, we're out of recession now, get back in the stock market. Markets bottom about halfway through. So you need to tend to watch that closely. There are some things that you can look at, some indicators you can look at that tell you high probability when a recession should hit. One of those hit recently. It's called a yield curve inversion, but it tends to tell you have about 19 months before the recession actually occurs. Some of the other indicators simply haven't hit yet. And so this could be an anomaly, a recession very early on. The weird part about this and why it's so debated is because companies are still growing earnings. Companies are still making money. Earnings are expected to grow about 9 to 10% this year. And if you think about it, this inflation we're all experiencing, it's not a secret anymore to companies. They know what these input costs are. These higher input costs are being factored into their business planning as well. We don't have to like it, but they still have margins there that could compress a pretty good amount before their earnings are actually taken away. So it's not a foregone conclusion that recession is imminent tomorrow without question. I'd say, just to highlight that one more time, as you get close to recession, the key thing that most people have not done is to rebalance the outsized gains of the past 3 to 5 years. We see people that had 60% in the stock market and now they've got 72 to 75% stock market, and that's probably a bit too aggressive for those individuals. So I'd say take a look at your high level allocation is how you can probably do least wrong there. Let's see. Okay, we hit all those questions. I got one question about Roth conversions. That's a different topic in itself. That is sort of converting IRA assets to a Roth that we can go over in the future. This wanted to specifically stick to 401k strategies here. So we'll wrap up. If you guys don't work with us, don't be a stranger. We're happy just to have a conversation with people. Use us as a resource. We love what we do. It doesn't hurt to have a conversation. So give us a call, send us an email, and thank you guys for your time today.